Marco, thanks for coming on the show today.
Peter, it's my honor and I'm excited about it. I haven't talked to you in a while, so this is going to be great.
Yeah, I think we were just chatting before we started recording. It sounded like it was back in 2018. It's been a little while. So I'm stoked to catch up and see where you've been since then, and then also where your business has grown from then. Before we do, can you tell us and tell our audience a little bit about where you were, when you first started real estate up into today?
Well, it depends on how far, but you want to go back, Peter. I mean, I bought my first rental when I was 18 years old. So I
Okay.
started, very young because that's what I wanted to do as a teenager. I wanted to start a business and invest in real estate. But, without getting too deep into that, I really just decided to go full-time real estate investing back in 2003 when, real estate was hot and on fire because it just seemed like the right thing to do at the time. And I made a lot of mistakes. I was investing out of state, but I bought 84 doors in a 9-month period, which is a heck of a lot.
Yeah.
But I wanted to just cut my teeth and build a large portfolio because I was after taking my life to a kind of another level of financial freedom. But here's the cool thing that came out of that. While I was doing that, people were coming to me saying, "Hey, can you help me? Can you coach me, mentor me?" And I didn't want to do any of that. But I did say this. I said I look at a lot of property and I underwrite a lot of property, and I don't buy it all, but I can provide you, property leads, if you will. I can hand these off to you, or I can just assign the contracts of stuff I'm not buying. That's really how my business was born. It was really just out of a necessity and identifying people who were wanting to invest in real estate. But to your question, that's really how I got real deep into real estate. As I just decided in 2003 that I want to invest in real estate full time, and I want to buy and hold, not flip. And I'm glad I did that. Made a lot of mistakes. Happy to share those war stories, with people who want to learn from the mistakes that I did. But that's ultimately what happened.
Nice. So let's go back to 2003 and chat a little bit about that. So you start investing and you're doing buy and hold. So how are you getting the capital for that? Were you working a full-time job and were you investing on the side, or did you have a couple of partners that got the money together with you and invested with you?
Peter, that's a great question. I was not syndicating at the time. I did have, first of all, I will say that most of the properties that I was purchasing at the time were lower priced. I was focused, unfortunately, in mostly C-class neighborhoods. So, we're talking relatively inexpensive property. And I was also investing in markets that were not expensive, like California or the coastal markets in the United States. So I had that working for me. Also, if you might remember, credit was pretty cheap back then. It wasn't all that difficult to get financing, and there were also 90 and 100% financing options. In fact, back then you could get an 80% first and a 20% second. So as long as the numbers worked on the purchase, you could literally get 2 loans for 100% of the purchase price. So you didn't need a down payment. In fact, I remember there was a time when financing was up to 103% of the purchase price. So they would actually provide you an extra 3%, which covered all your closing costs. So it was truly a nothing down investment. The other thing too is because credit or lending standards were so relatively easy back then, you could actually structure creative financing deals with the sellers of properties and structure it in a way where you didn't have to come to the table with a down payment. And even if you did, you could structure it in a way where you're getting some back at the closing table, like literally on the settlement statement, and then work something out with the seller where they will contribute part of that purchase price back to you as a rebate or a repair credit of some kind. I forgot what the verbiage was. So,
Yeah.
This is unfortunately, some people abuse that and some people used it wisely, but that's part of what led to, a lot of the fiasco of the housing market and, crash in 2006, which led to the Great Recession of 2008. There's just all this loose credit. So you got to be very careful with it, that you don't over leverage yourself because you might lose your property. But that's how I did it. It was just creative financing, easy credit, and structuring my deals creatively. So it's not like I had an infinite pool of capital.
Yeah, that's huge. So I didn't know in detail how it was back then. I mean, I've heard a lot of stories and everything else where it was loose lending combined with a lot of other stuff, and that's what, extrapolated the fact that we had a huge mortgage crisis, and so going back to that, I didn't know that there was so much involved with how many people were able to kind of manipulate the closing statement to put them into a position to win for themselves, right? So there's a lot of that, and then there was some other stuff. So how did you kind of fast forward to 2005, 2006, 2007? What were you kind of looking at? Were you looking at the writing on the wall, or did you say like, hey, this is I'm still going to be good for quite some time?
You're talking about in light of the housing market crash?
Yes.
I didn't know we were heading towards a crash until 2006, which was the same year that the crash was actually happening. For most people, they weren't even aware of it. But what happened is one day, I obviously I had my business running at that time. The business you're familiar with, Norada Real Estate Investment. So we were working with investor clients. We were helping them invest in real estate and build their portfolio. And a lot of our new construction at the time was in Florida, mostly in Florida. And the lenders we were working with were providing what they called construction to permanent loans, or construction to perm loans, or also known as CP loans. So that means that you as the investor or the borrower would get approved for financing, and then the lender would finance the construction and then convert that loan into a permanent 30-year fixed loan. So it's one close, but two loans. And we were doing a lot of these loans. It was the norm back then. I got a phone call one morning from one of the lenders, our primary lender, and he basically said, this is the loan officer, he said, got some bad news for you. Our main lender who's providing these loans just pulled the loan product out from under us. It no longer exists. And that is retroactive to everybody who's in escrow right now. So we had, I can't remember how many dozen clients in escrow in new construction to invest and buy property. And those loans were pulled right from under them. So that was the first sign. That was the writing on the wall telling me that, okay, lenders are starting to get concerned. They're tightening up real fast and pulling loan products out from under, from people. And it was kind of a mad scramble to find replacement lenders, which we did for a very short period of time. But that's when I knew that, okay, we've probably hit a top. And with credit drying up, we definitely are going to see a market correction, because if you don't have that credit, if you don't have the lending or the financing, people are not going to be able to purchase, or as many people are going to be able to purchase. But I didn't know any of this in 2005. I mean, we saw strong appreciation, like crazy appreciation in some areas like Southwest Florida. Mm-hmm. But it wasn't until lenders actually started saying, hey, we're pulling our product, that if you haven't watched that movie, The Big Short, I assume you've watched it.
Yeah.
That is a great movie. It's one of my favorite movies. And that is actually pretty true to what happened, like to reality. That movie's great.
Yeah, that movie's really good. Speaking of tighten up lending procedures and processes for the lender, Fannie Mae, Freddie Mac, they just came down and they changed some stuff, and I'm sure you're aware because you do a lot of stuff for just investment properties alone. But the beginning of April, they said, hey, we're going to come to, a limit of basically buying any type of, secondary loan from any lender, broker, or anything like that at a 7% cap. So basically they're going to cap it at 7% of investment properties or second homes. Are you familiar with this?
Yeah, I don't know a lot of the detail on it. I've heard about it. That was a concern when I first heard it. It hasn't affected us at all at this point. And probably because there's still, there's a large number of people who are investing in real estate, but it hasn't exceeded a point where it's hitting that 7% cap in terms of non-owner occupied loans that they're funding. Mm-hmm. So I've yet to be denied for our clients a non-owner occupied loan, like a conventional loan. So could it happen? Possibly, but yeah. I think they just wanted to define it. But I don't think it's an issue at the moment.
Yeah.
Nobody's telling me it is.
No, I don't think so either. I just, it just raises a flag, not a red flag. It just raises a flag just to make sure that, everybody's cognizant to see, if the banks know something that we don't or anything like that, or they see something on the horizon. I don't think so. I think what it comes off is the heels of how many investment properties. I think it was up like 80% last year, investment in second homes that people were buying. And I think that's just the loose money that's floating around. I believe, and that's kind of what I've read too. So I just want to get your take on it, especially because you're so involved with second homes and also investment properties yourself. So go ahead.
Okay, I'll make a quick comment about that. What I think they know, but most people don't talk much about, is that the lending risk to a real estate investor is far less than the loan made to a homeowner. And most people think it's the other way around. But investors, being essentially business people or entrepreneurs, but as investors, they are smarter with their investment capital and how they treat those mortgages, because they know that they need to protect their credit, they need to pay the loan, and they can't screw around. So investors in general are more responsible than homeowners. Not all homeowners, but a lot of homeowners, because they realize that this is not a one-shot deal. It's not one loan that I'm after. I need to get a second and a third and a fourth and so on. So they're certainly more responsible with their money and with their investments and their mortgages. So it's a better risk profile for Fannie and Freddie in the secondary market to be issuing loans to investors than it is to homeowners. We're an important part of the housing market and the economy.
Yeah, I agree with you on that, and especially your insight on being a business owner, owning a lot of investment properties. As that investor, you're in a position where you need to make sure that you're not over leveraged. You're in a position where you can definitely buy those properties, and you're in a solid spot comparatively to sometimes a homeowner. So going through 2008 to 2012, where were you in that cycle, in the sense of, what were you guys buying? Did you guys really hold off for, a majority of the years into 2011, 2012, and then start buying again? And what did that look like for your real estate investing and also your business?
Well, after 2008, inventory dried up for a short period of time, but then as the foreclosures that were in the pipeline started to come back out, we started to see a lot of distressed assets, and that's when things started to pick up, is around 2010, and we hit a bottom in 2012 as far as most of the housing markets around the country. But what the beautiful thing for real estate investors is, we had low prices, great opportunity to invest in cheaper real estate, and a lot of inventory was coming out from banks, distressed assets from all over the place. That allowed rehabbers, especially larger scale professional rehabbers, to acquire those assets, fix them up, and be able to resell them as a retail sale or a turnkey real estate investment. What we were offering into investors.
Yeah.
But the problem was, as much as there was a lot of great inventory, at the same time, credit was pretty dry. It was tight. It's not that it didn't exist. It's just you had to have great credit, a good credit profile, to be able to qualify for financing at that time to buy those properties. So if you had great credit, you could load up on some really good deals from 2008 to 2012. And then credit started to slowly loosen up. So we had to scale back. I had to lay people off because, sales had dropped off a cliff. Like, things were much, much slower. But we were one of the few companies, actually, interestingly enough, to survive through the 2008, Great Recession, the collapse of the housing market. All of our competitors at that time basically disappeared, other than maybe 2 or 3.
Yeah. I would, suspect, especially in that crisis, a lot of people, outside of me hearing, a lot of people backing out of the whole market in general. A lot of people did. And fortunately enough, you guys were able to be in a position to not do that and still be in there, for your investors. Some takeaways coming back, to you going through those years. When you look back and you see, okay, we went through this, how do you, moving out of that, structure your business? And I guess at this point we can transition to talking about, what you guys do today and how that kind of looks as a business model too.
I mean, our focus is to provide high quality product, both new construction and newly refurbished homes in good markets, in good neighborhoods. So good product in good markets, good neighborhoods with professional property management, tenant occupied, cash flow positive, with good or strong price appreciation or growth potential. Those are the things, those are the elements, if you will, that make up my definition of a turnkey real estate investment. And then when you wrap the team around it and the people you're working with and the experience, that's what I refer to as turnkey real estate investing. So our business model and our investment philosophy hasn't changed over the last 17 and a half years. It's the same business as it always was. We've just improved and refined upon it. But, I always tell investors, look, focus on good markets, good neighborhoods, good property, where the numbers make sense and have the right team of people around you. Your acquisitions person, your property management, your lending people, whatever lenders they may be, your asset protection attorney, and your tax advisor. When you have those key 5 people and you're following that formula I just gave you, good or great markets, good neighborhoods, good property, it's really, really hard to fail, really, especially in today's environment, with lack of supply, strong demand, property values going up, rents going up, strong demand for housing. It's hard to screw it up unless you break one of those key variables in that success formula.
Yeah, no, I agree. So where are you guys at today? After last year, we hit COVID. What did that kind of look like? And did you guys get hit pretty hard, or was there, a quasi smooth transition from, March of last year into April, May, and June?
I think like most businesses, after March, like nobody knew what was going on. There was this fear, uncertainty, and doubt, in the markets with what is this coronavirus? And, I think the media just really hyped it up a little too much, but it created a lot of fear and uncertainty. And, everybody felt it, in terms of jobs, the stock market, real estate investing for a short period of time. So there was a short period of time there for about a month or two where investors were just pausing, pumping the brakes, or pulling back. We had a few people cancel contracts. So there was about a month or two where things had kind of dropped down. But here's the interesting thing. Things picked up very quickly right after that, but picked up even stronger than pre-COVID. So January and February were very strong months at the beginning of 2020. Then there was a drop off March and April, and then things took off like wildfire after that. And if I'm not mistaken, we had 3 record sales months last year in our entire 17 and a half year history. So demand just went through the roof. I mean, it was already strong before COVID, but a lot of businesses have told me the exact same thing, that last year was crazy busy for them. So it's an interesting thing, restaurants, some service businesses suffered, because you couldn't go out or people didn't want to go out. But other businesses thrived, especially in the financial sector and investments and real estate and whatnot. Strong demand, lack of supply, those it's economics 101.
Yeah, I agree. So how are you looking at it going forward? If I was going to sit down with you, I was an investor, I was going to say, hey, I want to park some money with you. What are you guys looking at in the next 2 to 5 years?
What are we looking at in terms of
like the market, what your business model, what you guys are going to do, and what you're really thinking about, as a strategy? Are you guys looking to expand, exponentially? Are you on a slow incline?
Well, we're growing rapidly, and I don't want to stay focused on our business growth is really about you, the investor.
Yeah.
This is a very opportune time. It has been for many years, because we're in a situation right now where we have a housing shortage, right? baby boomers have been staying put. Freddie Mac estimates that by the year 2030, we're going to have a shortage somewhere between 1 and 4 million housing units. That's a huge shortage, and we're really not doing enough to keep up with that growing demand. So our supply is still shrinking year over year, relatively speaking, compared to demand. So this is a problem, and it's a growing problem. So demand is strong. We need over 1.6 million housing units right now every year just to keep up with the existing demand. And then we've got Gen Y and Gen Z. We've got the millennials and then the Gen Z generation coming out, and they're around 23 right now. And both of those demographics represent about 70 million people in the U.S. Well, now they're just starting to go into the housing market, whether it be rentals, first-time homeowners, they're getting married and they're wanting to get their first home. So they're just putting a whole lot more pressure on the demand side of this. And so this problem is growing, which means that if you look at what it's going to do, it's basically going to keep pushing prices up. It's going to increase rental rates. It's going to increase occupancy rates. It's going to increase property values. It's great if you're a real estate investor. It's great if you're already in the market, whether you're a homeowner or a real estate investor. It makes it a little harder if you're trying to grow your portfolio or get into the real estate market as an investor right now. But it's a rising tide. You're catching a trend that is expected to last for many, many, many years. So, this is why we remain market agnostic. We're not married to any particular market. We're always focused on markets that provide strong jobs, job growth, population growth, because those are the markets that have long-term growth prospects. As long as the finances work, like the financials on the investment properties in those markets, they make good investments because they'll cash flow to provide a rate of return. They'll provide, equity growth over time because of the appreciation. But we're not changing our business model. Our philosophy hasn't changed. The only thing that changes is really the markets and areas that we're focused on because of one, market cycle changes, market demand, and the neighborhoods and inventory. Inventory is very tight. So we're in 25 markets right now, but we don't have inventory in all 25 markets all the time because it's just really hard to come across. And anybody who's looking to buy real estate right now is going to be experiencing that exact problem. And if that wasn't bad enough, we have this problem of shadow demand. You've heard of shadow inventory. You just don't see it, but it's there. There was, shadow inventory on the bank's books back with the 2006 housing market crash.
Yeah.
So, that shadow inventory eventually came out. 2009, 2010, you started seeing all those foreclosures coming onto the market. Well, we have the same problem, but on the flip side now with shadow demand, where we have all this pent-up housing demand by people who want to buy real estate or want to get out into the market but haven't gone out in the market yet. But they're going to come out. And, this is the Gen Y, the Gen Z people that I'm talking about. And if you look at the percentage of U.S. young adults that are still living at home with their parents, which are people who are between the ages of 18 and 29, these are, U.S. young adults. It's the highest it's been in the last 110 years. The highest it's ever been was 48% back in the 1940s. We are at 52% right now. Think about that. 52% of U.S. young adults are living at home with their parents right now. Well, they're not going to stay there forever. They're going to want their own place. So this is the shadow demand problem that we're going to see, if not already, that's going to continue to drive numbers to crazy levels in housing.
Yeah. I mean, I can't say that, and second that enough, especially in the market that we see and the people that are still coming out in growth, to get property, to buy their first home or buy, an investment property, especially with all the money that's been printed, because there's more and more money on the table for people. I think last year was the biggest year, for one of the biggest years, they printed money within the last 40 years. And then also on top of that, it was the division between the poverty line and then also the wealthy grew substantially just because, how much was going on last year. So yeah, I agree with you. I second you on that. So what markets are you guys in?
All our markets are either, well, it's on the eastern half of the U.S., with the exception of Phoenix, Arizona, the outer growing suburbs of the Phoenix metro. But there's markets in the Northeast, the Midwest, South and Southeast. Some of the major markets, if you will, include Southwest Florida, Jacksonville, Florida, San Antonio, Texas, Houston, Texas, Kansas City, Missouri, Indianapolis, Indiana, the northern Indiana markets that are outside of the Chicago metro area, and some parts of the Chicago metro area. Pennsylvania has been a hot market for us. We sell probably at least 30 rental units a month in PA. What else is there? We're in the Ohio markets. I mean, the Atlanta metro, but again, like I said before, we don't always have inventory. It's sometimes pretty tough. We're in 3 markets in Alabama, which the numbers make great sense there. I mean, from a cash on cash perspective, Birmingham has been phenomenal. But again, sometimes there's challenges with inventory. But if you're an investor listening to this, the eastern half has far more opportunities. The numbers make far more sense on the eastern half of the U.S. than on the western half, just because property values have just appreciated so much, and the rents haven't kept up with that growth.
Speaking of rents, do you see with potential inflation increase, do you see rents going up, and do you think that they're going to go up, or I projected soon to go up, but do you think they're going to be going up for the next couple of years?
Oh, without question. I mean, rents have been going up year over year for many years now, because of strong demand for rentals and a lack of supply. But also property values are increasing. So, rents tend to follow price appreciation with real estate, but not as fast, not right away and not as fast, but they do, lag behind and increase. But because of a shortage of housing and the strong demand that is continuing, to grow, and probably will for the next 10 years, you'll see rents continue to increase. There's no question that there's price inflation, with property values and rents. It's there. I mean, no matter where you look, you see it.
Yeah. So when you guys go into a market, how are you building the team, or do you have a team that builds that team there in those locations? How do you kind of run that?
Well, we have a team in every market, and that includes one or more builders or professional property rehab companies, which acquire slightly distressed properties, fix them up into like new condition, and provide it to us. So what we're selling is new or like new. But also we have separate companies in every market that are professional full service management companies that are essentially just focused on property management, dealing with the tenants, any maintenance issues, et cetera, et cetera. That's a critical player on your team. So those are the key people who are essentially boots on the ground. Beyond that, they don't have to be local. Your lenders can be anywhere in the country. Your asset protection attorney can be anywhere. Your tax advisor can be anywhere. But those first two are critical boots on the ground. But we definitely have a team in every market. You have to.
Yeah.
And they provide us also some market intelligence and data as well. So I collect data from multiple sources and review it and just check, keep my finger on the pulse of markets and just see what's going on. Right now, everything's very bullish.
Yeah.
I guess, it's a good thing for, like I said, if you're in the game, if you're in real estate, it's very bullish.
Yeah. Yeah. I think that goes across the board of, just real estate, and then also the stock market. The stock market's doing really well. What it's been like for the past few years, outside of the blip that happened this time last year with the stock market. So for you, and I know you're in Southern California, do you really focus like yourself on investing in California at all, or do you just focus on stuff outside of California?
Well, some people might hate me for saying this, but I like to say I wouldn't touch California with a 10-foot pole. The problem with California real estate is it is very expensive, arguably overpriced. The big thing is that the rents are not high enough. The rent to value ratio or rent to price ratio is not high enough for there to be a favorable cash on cash return. Now, for those investors who are a little bit more of a speculator, that are looking for just price growth, price appreciation, assuming they get that, then a low cash on cash return doesn't matter, because they're really just parking their money into the real estate and looking at it long term for the price gains, assuming they're there. But the question is how long is that going to go on for? You're making the argument that property values will continue to appreciate for the foreseeable future, if not forever, in some people's opinions. That may be true, but we all know that California markets, especially coastal markets, are very cyclical. They will appreciate very quickly and strongly, in boom years, and then they do tend to correct. So if you're trying to time the market, so be it. But you can have strong price growth in many other markets that are not as cyclical. They're more linear type markets where it's a more smoother growth, a growth curve in terms of price appreciation. It's not as roller coaster like, but you still have strong appreciation. So you get better cash flows and you have strong appreciation over time, and you could sleep better at night. But I don't like California because of its cyclical nature. And I just think the timing is not good right now because we have such high property values. You buy $1 million property, 20% down is $200,000.
Yeah.
You're not going to have strong cash flows or cash on cash returns. There are exceptions to every rule, of course. I'm not saying that's true everywhere.
Mm-hmm.
And I'm not trying to put California down, but you can take that same $200,000 and you can acquire 4 to 6 3-bedroom single family detached homes in some of the markets I was just talking about that are in strong B+ or even A- neighborhoods that will deliver strong price growth, strong cash flows, have a lot of stability and less downside risk than the properties you're buying in California, because in California a lot of the value is in the land, not so much the improvements on the land. Whereas in most other markets, the improvements on the land are worth far more than the land it sits on. It's almost like 30%, 20-30% in the land, 70 to 80% is in the improvements on the land, the building itself or the construction. California, a lot of places, it's kind of flipped around. The land value is so high relative to the improvements upon it. And, we don't always have the best political environment here, or the tenant landlord laws are certainly skewed towards tenants in California. And a lot of investors don't really like that. It can work against you if you have what I call a professional tenant that knows how to game or work the system against you. They could literally stay there rent free for 6-9 months.
Yeah, I agree. So if you could handpick 2 markets that you're really bullish on right now, it sounded like Alabama was one. And what's another one that you would pick out and you would say, this one, what we've seen in the past six months to a year has been the best we've seen in a while?
Well, I'm bullish on all 25 plus markets that we're in, but for different reasons. If you're looking for good cash on cash returns, and a stable market with growth potential, parts of the Memphis metro, the Birmingham metro, Kansas City, Indianapolis, northern Indiana, northwest Indiana, Cleveland, Cincinnati, and Pennsylvania. If you're looking for stronger price growth, San Antonio, the outskirts of the Houston metropolitan area, Southwest Florida. We're in about 5 markets in Southwest Florida. All our Florida markets. So that includes Jacksonville, Ocala, Orlando, parts of Orlando, and 4 or 5 markets in Southwest Florida. That quadrant down there. Those are all strong growth markets.
Okay. That's good to know. I don't look outside of California for real estate. So I'm always curious, where I look in Arizona a little bit, but I don't really look outside other than that. So
I'll add to that list, Peter. I forgot that we are actually building brand new construction triplexes and fourplexes in the Phoenix metro. So it's not in the city of Phoenix, but it's in the south or the northeast and northwest quadrants of the metropolitan area.
Okay.
So this is in the path of progress, and there's a lot of growth going on, a lot of people moving in. I mean, it's just a booming area, booming. Well, the whole Phoenix metro area is booming, but so that is the one Western side U.S. market that is also a strong growth market that I'm very bullish on as well. But that's really the only market that we are in that's on the essentially the Western side of the U.S. We were in Idaho building new construction fourplexes. We still may have some left, but as far as I know, that those developments have been completely sold out. And Salt Lake City has been a very strong growth market. I mean, Utah as a whole has been, but the whole Salt Lake City metro area has been very strong. A lot of Californians are moving there.
Yeah.
So
yeah.
It's helping to drive that growth.
I would say, I have some family in Arizona, so I go there quite a bit, and I know that's a massive growth, like you said. A couple other areas, Idaho and into Utah, and I know into obviously Texas and Florida. So you're in some great markets for sure. So, so we'll
done very well in those markets.
Yeah, I know, especially you guys being able to diversify across all those markets and help your clients out is huge. But at the same time, be in those markets, especially now after what took place last year and a lot of movement in the last couple of years. So that's huge. So good for you and good for your clients. That's awesome.
Yeah.
So let's transition a little bit. Do you have a book that you read in the last, 5-6 years that really helped you transition your business from where it was to where it is today that you can recommend?
Well, if you want to go back that far, as soon as you started asking the question, I was thinking of one specifically that was a person that I interviewed 3 weeks ago on my podcast. I was going to recommend that, but then you said 5-6 years ago.
No, good. Well, actually, I take that back. If you go, it doesn't have to be that far. It could be, the last 12 months.
Well, I'll give you two. I'll mention two because you did go back 5-6 years. So one book you probably have heard of it. It's a book called Traction by Gino Wickman. He writes about EOS, the Entrepreneurial Operating System. So if you're running a business, it's a good book to help you build a framework for all the parts of your business to help systematize it and then grow it. So it's a very good book. It doesn't work for everybody, but if you got a business that is less than 50 employees, it's a great book to help you strengthen and grow your business. Okay. The other book I was thinking of though is a book called Raise Your Game, and it's by Alan Stein Jr. It's a book about high performance, and I have to tell you, it is a fantastic book. It's a very easy read, and it's all very meaty material and very actionable. And I love everything he has to talk about, as far as focusing on the basics. And he used to actually coach. He used to be the performance coach for a lot of the top NBA players. Kevin Durant. What's the? I forgot it. Who's the guy who had it? Was in a crash. Kobe Bryant.
Oh, Kobe Bryant, yeah.
Yeah, like a lot of the A-name NBA players is who he was the performance coach for. And so he's learned a lot from them, and he uses them, as examples to illustrate all the, concepts of high performance.
Yeah.
It's a really good book.
Yeah. Tim Grover. Is that who you're talking about? Tim Grover?
No, Tim Grover wrote another book.
Yeah. Oh, okay. Yeah, Raise Your Game. I haven't heard of that one. I've read.
It's an orange book. It's called Raise Your Game. The author is Alan Stein Jr. Alan Stein Jr. Okay, cool. Yeah, great guy, by the way. I've come to know him. He's a really good guy. Yeah, he really knows his stuff.
Yeah, I'll check that one out. Yeah, I've read Tim Grover's book, but I haven't read that one, and first time I've heard of it. Okay, cool. And what are you using today for your business? An app, a online resource that's really helping the business out?
Does it have to be recent or something we've been using for a long time?
No. Something you've been using for a long time.
I don't know if this is going to be revolutionary, change anything. I mean, you've probably even heard it before. I mean, as far as the tools we use, we really use the entire Google suite, like the G Suite of apps from Google. It's paid. It's paid. It's not I mean, they provide a lot of it for free, but the G Suite is like a paid suite of software, but it includes a ton of stuff. That's really the basis of what we use. And then we just have a CRM application on top of that, which is called Pipeline. And that's, for us, it's been great. It's an easy to use system.
Yeah.
But, we're not too fancy. We don't use Slack. We don't use, whatever else. I don't even know what else is out there, but yeah, we don't have a lot of apps.
No, that's perfect. I mean, simplicity definitely is something to, boast about, because, business can be very convoluted. So it's cool to hear something where it's, that simple to get everything, in one place.
Yeah, the more you add, the more complicated things get, and the more things you need to check. I mean, I've already got like 12 messaging apps on my phone.
Yeah.
It's like, you're bouncing back and forth between all these different apps. It's like, this is too much. It's crazy.
Yeah, I agree with you on that. Okay, where can our audience find out more about you, Marco?
Really, just our two websites is the place to connect with me or my team. We're all here to help answer questions. We do everything for free. We don't charge for anything that we do ever. But the two websites is noradarealestate.com, NORADA, noradarealestate.com. And then the sister website is really the home of my podcast called Passive Real Estate Investing. And the domain name is exactly the same as the name of the podcast. It's passiverealestateinvesting.com.
Perfect. Awesome. Well, we'll be sure to put those in the show notes so everybody can check you out and see where you guys are at. And then obviously search around your website to see, where markets you're in and everything else. And also on top of that, check out your podcast. That's awesome.
By the way, there's on our website, there's a free download, which I think you already know about. It's called The Ultimate Guide to Passive Real Estate Investing. It's like a 30-some page primer. Great educational tool.
Yeah.
But we're coming out with a full-fledged paperback book based on that same report or guide, based on that guide. The book will be called Passive Real Estate Investing, and it's basically the full enchilada. But we're going to make the book available for free. So people who download that guide will get a notification this summer when the book's coming out. And so they'll have access to the book as well. At no cost.
Nice. That's awesome. Yeah. I'll put that in the show notes too, that it's coming out. So that'd be sweet to have that too, because that little ebook that you guys have is perfect, and to expand on that is huge. So that would definitely help out a lot of investors. Yeah,
for sure. That was the idea, is really just to help people learn what we know and help them move forward. So
yeah, that's huge. Okay, cool. Well, thank you so much, Marco. I know you're a busy guy, so thank you so much for coming on the show. And I really appreciate you jumping on and going through your story with us. Thank you.
Anytime, Peter. Thanks for the invite. It's been a lot of fun. I appreciate it.
Yeah, of course. Thank you.